financial deregulation has often been blamed for the economic meltdown, with then-Senator Barack Obama late in the 2008 campaign season ceaselessly condemning the Bush administration's alleged drive to strip away regulation. We'll have more to say about the financial deregulation in the next chapter, but with regard to the housing market, the point is that lenders were doing exactly what the federal government and its central bank wanted them to do. Saying that more government oversight was needed misses the point. More and riskier loans are what the government wanted. No amount of regulation is going to clean up the mess that was created because the government wanted more mortgages to be put out on the market to begin with. So fashionable opinion everywhere, especially throughout the government sector, cheered as traditional lending practices were abandoned and riskier ones adopted. Why? The American dream is being extended to more and more people. Now remember that the American dream is that idea that everybody gets to own a house, you get a car, you live out in the suburbs, you've got a big yard where your kids can play within the confines of a white picket fence, and you've got a dog or a cat, and you belong to the local golf club. That's the American dream, at least of the 1950s. And it wasn't just the Democrats, not by a long shot. In 2004, George W. Bush urged the Federal Housing Administration to lift the down payment requirement altogether for 150,000 new homeowners. Again, taking the risk away from the homeowner and putting all the risk on the banks because the homeowner doesn't have any skin in the game. He declared, "To build an ownership society will help even more Americans to buy homes. Some families are more than able to pay a mortgage, but just don't have the savings to put money down." The down payment, which had traditionally served to minimize defaults, was being swept aside by the president himself, and thus the trend away from traditional lending standards received a presidential imprimatur. We are supposed to place our hopes in regulators who would have to be courageous enough to stand up against the entire political, academic, and media establishments. What regulator would have done anything differently, or dared to tell the regime something other than what it obviously wanted to hear? People in high places, whose exalted offices lent an undeserved air of authority to what they said, assured everyone of the fundamental soundness of the system. Ben Bernanke himself assured the country that regulators investigating the mortgage market had found a smoothly functioning system and no cause for alarm. Our examiners tell us that lending standards are generally sound and are not comparable to the standards that contributed to the broad problems in the banking industry 2 decades ago. In particular, real estate appraisal prices have improved. In 2004, 2 Fed economists published a study arguing there was no housing bubble. Former Fed Chairman Alan Greenspan actually encouraged borrowers to use adjustable rate mortgages, which have since begun to reset at interest level rates that mean certain default for an ever-increasing number of homeowners. In 2003, Greenspan said rising housing prices did not amount to a bubble, though he did not expect them to continue to rise quite so fast. The notion of a bubble bursting and a whole price level coming down seems to me, as far as a nationwide phenomenon, really quite unlikely, Greenspan told the Senate committee. Apart from the economists of the Austrian school and a few others, who consistently pointed to the housing bubble and the damage it would inflict when it inevitably burst, few and far between were the voices of caution and sanity. Few could imagine that the entire real estate sector could experience a decline all at once, an idea that ran directly counter to the conventional wisdom that real estate was local and not characterized by national swings. Some of the major financial institutions proceeded on the assumption that the housing boom was based on real factors and was not a mere bubble. These firms' behavior appeared risky only if the housing boom was a bubble. But the Fed's own economists deny that the housing boom was a bubble. What makes anyone so sure that a regulator would have seen the risk involved in these firms bet that the housing boom was based on real factors and was not a bubble? Even if some miraculous means were available by which regulators, given the task of overseeing the books of major financial institutions, could eliminate all major risk and see the economic picture more clearly than those whose own financial well-being actually depended on the outcome, we would still be dealing with a symptom, albeit a significant one, rather than with the cause. As long as the Fed can create as much money as it wants and push interest rates down to destructively low levels, bubble activity, that is, wealth-destroying activity that seems profitable only because the Fed has kept interest rates artificially low, will occur somewhere. If it wasn't the mortgage markets and the financial industry that became distorted, it would have been something else.